Welcome to the Scouting Report, the market outlook, market update for second quarter of 2026. I am Adam Koós, President, Portfolio Manager, and Senior Financial Advisor at Libertas Wealth Management Group in Columbus, Ohio. If you'd like to follow us on any of the socials, here they are. If you'd like a second opinion on your portfolio, your retirement plan, I'll mention it again at the end. Feel free to go to our website at libertaswealth.com. Otherwise, let's go ahead and jump right into the material because we have a lot to go over. And I always like to start with a quote. And today's quote is, "Those who have knowledge don't predict, and those who predict don't have knowledge." So I don't know if that's profound to you, but it sure is for me, especially in these days with what's been going on in the market. So let's talk about the U.S. stock market first. I want to show you just the U.S. stock market here. That's the S&P 500. We had, as you can see here on the left of the chart, the market going down during the tariff crash. This is a 200-day moving average, which is a 200-day trend line, basically smooths out the ups and downs in the market, and you can see it went below water, as I like to call it, which is why I make it blue. Tried to get back above water and then just kind of collapsed and sank and sank and sank, and it took a while before things were able to get back above water into a positive trend again. This time around, it wasn't nearly as bad of a decline, and I say was, I'm speaking past tense because as of yesterday, I'm recording this, by the way, on Thursday, April 9th, so this is as of the market close on the 8th, we had a huge gap up, which is what you're seeing here in this little notch, or this candlestick here, and we are back above the 200-day moving average, or in other words, back in a long-term trend, which I'll go over in a little bit more later. When you look at small cap stocks, so small company stocks, this is a long base here, going all the way back to late 2021. Market couldn't get above that line in the sand, fell, built out a base again, couldn't get above it a second time, fell down a second time, got above it. We call this a bull trap. So it bounced above that line but fell back and then finally broke out. And then it fell below that line in the sand during this most recent Iran war. And we call this a bear trap because it went down, looked bearish, but it ended up pulling right back above that line in the sand. So we're back above that line, which is, for me, a very, very linear, easy place where risk management exists for us anyway at our office. And if you looked at microcaps, by the way, they look very similar. If we look at the international stock market, it looks a lot like the U.S. market. The only difference being it looks a little bit better. We'll talk about that in a second here. But as we look at this chart, international stocks are doing well. The question is, which is doing better, the U.S. or international? And as you can see here, this is a comparison chart. This is not the U.S. stock market. This is not the international stock market. This is a comparison between the international markets, so ex-U.S., so everything overseas outside the U.S., versus the U.S. stock market, or in other words, the S&P 500. When it is going up or trending above this rising, currently this rising 150-day moving average or 150-day trend line, that means international is doing better than the U.S. If it's going down, like it has been for so long, and when I say so long, I mean since 2008 for the most part, international has been underperforming the U.S. for a very long time. We are seeing for the first time since 2008, since the Great Recession, a period of time where international is really starting to hang in there. We'll have to see what happens with the U.S. dollar, which we'll look at next, but if things hang in there and the U.S. dollar continues to weaken, both of those things could mean really, really good things for stocks overseas. And here's the U.S. dollar. And you can see, kind of like small cap stocks when I was showing you earlier, there's this line in the sand that acts as almost like polarity. There's familiarity here. And the human psychology is that every time the U.S. dollar hits this point, that sellers jump in and push it down. Hits this point again, sellers jump in, push it down. It breaks out here in late 2016, early 2017, but there's just not enough buyers and or too many sellers apparently, pushing price right back down again. Happens again in 2020, just after COVID. And then finally, the dollar starts doing really, really well here in 2022, 23, kind of hangs in above that line in the sand, but it's fallen back below there in 2025, and it just can't seem to get above that line again. So this is that line in the sand where if the U.S. dollar cannot get above that line, then international stocks are probably going to outperform U.S. stocks. It's not guaranteed, but it's definitely a big, huge notch on the wall in favor of international stocks. And here's the proof. This is JP Morgan's Guide to the Markets. They do this every quarter, and I just saw this in there, and I thought it was a really, really cool chart to share. So whenever the graph here is up, it means that international is outperforming U.S. stocks. So whenever the graph is up, international is better than U.S. Whenever the graph is down, below zero, that means that the U.S. is doing better than international. And the shaded areas are times when the U.S. dollar has been going down in value. And the reason why that's important is because all things held constant, when the US dollar goes down versus other currencies overseas, that makes international stocks do well just through currency exchange. And that's it. So, and you can see here, like I mentioned earlier, since the Great Recession, the U.S. has been outperforming, or in other words, the international stock market has been underperforming the U.S. for a very, very, very long time. And you can see right now the dollar has been declining for quite some time now, several months. And the question is this going to be a period of outperformance coming in the future for international stocks, which is something we're watching very, very, very closely. Let's talk about bonds, fixed income. This is going to look, if you've been watching any of the articles that we write, any of the videos we put out, podcasts, updates on the market, this is not going to look all that different because bonds are still just struggling. If you want to make money in the bond market right now, you have to be pretty nimble, pretty quick in terms of your time frame from a trend standpoint. And unfortunately, when it comes to bonds, I don't think most people want to be nimble and quick when it comes to trend following. So it's been a tough place to be, the bond market, for a very long time. I mentioned before in prior videos that we were pretty much out of the bond market between 2022 and the vast majority of 2023, 2024. And then we just got into the bond market in 2025. And now, today, all we own at our office and our portfolios is convertible bonds. And as you can see here, this is bonds that convert to stock. This is, the chart looks good, right? I could put my hand over the name on the chart, and it shouldn't matter what the name of the investment in question is. If it's going up, it might be something we want to own. And this is convertible bonds. ICVT is the iShares convertible bond in ETF, and it's the only bond position we currently own. That could change next week, next month, but at least for now, we own a lot of short-term treasuries, which are doing well, and we own convertible bonds in our bond portfolios. Switching over to commodities, gold is still looking pretty good. It's pulled back, obviously. It's kind of corrected, if you will, over the past several months, 3 months, just because obviously it's something that goes up so parabolically can't keep doing that forever, right? So it's taken a breather here. Whether or not it continues going up or not, it's going to have a lot to do with interest rates, inflation, and then, of course, the Iran war or any other geopolitical events. Gold tends to be a fear trade. So when things are scary, people tend to flee toward gold as a safety trade. So silver looks very similar, different but similar. And I don't know that there's a whole lot else to say here. Silver's done very well as well, still in an uptrend. And then oil, obviously, due to the Iran war, has done really well. I know it might sound strange or counterintuitive, but when we go to war with a country in the Middle East where there's a ton of oil being shipped, produced, processed, supply and demand, right? So less supply, same demand, price goes up. It doesn't matter if demand goes up or down. If we see a big reduction in supply, things get scary, prices go up. So oil has done really well, primarily on a news-driven market with everything that's going on in Iran. Taking a look at some relative strength rankings that are important in the market when it comes to risk, what's safe, what's not. This is a comparison, kind of like the U.S. versus international comparison I was showing you earlier. This is a relative comparison chart between consumer discretionaries and consumer staples. I know those are big words and they sound nerdy, but basically what that means is we're comparing discretionaries or luxury goods or things we want versus staples, or in other words, things we need. So think things that we want that are nice to have, that are luxurious versus, razors and milk. So as you can see here, currently in the short term, this is underwater, which means that staples, or in other words, defensive stocks, are winning this battle currently. But if you look long term, we're still seeing higher highs and higher lows. So I think it would take a little bit more, we'll call it weakness, on the part of the market, on the part of luxury goods versus staples in order for this to continue breaking down. But we're going to have to see what happens. Based on everything else that's going on in the market, I would not be surprised to see this turn back up again. But it's just one piece of evidence, right? That's what we're trying to build here, is a weight of the evidence picture, looking at a bunch of different metrics, a bunch of different charts, indicators, and we're trying to say, okay, not is it safe to invest, yes or no? We're looking at probabilities, right? So we're trying to build a percentage out. So that's, we'll call it a notch in the bear's belt. This is technology compared to utilities. Again, if the chart's going up, that means technology is winning. If the chart's going down, that means utilities are winning. Technology is obviously a very offensive sector, whereas utilities are it's a defensive sector. So right now, again, what we see here is this chart is underwater. That means technology is struggling versus utilities. In other words, the defensive sector is doing better. And that's obviously short-term not good, another notch in the belt for the bears. However, I'm still seeing a really, really wide base here. If you take away the moving average or the trend line or this water, if you will, if you take that all away, what I'm seeing is just kind of a sideways trendless long-term market, or comparison, I should say. say here. So this is kind of neutral to negative. Negative in the short term, I'd say neutral long term. Long-term asset class ranking, when you look at kind of the big picture from a 30,000-foot view, the number one asset class in the market right now, using this particular comparison method, is international stocks. Number two is domestic stocks. Number three, kind of screaming out of last place here over the last, call it 9 months, is small caps. So small company stocks have really been getting strong, especially since December. Then commodities are just behind small caps. And then we have treasury bonds and then T-bills. So basically bonds in the basement sitting with T-bills, or in other words, money market, cash. So that's just more bad news for bonds. But when you look at this, even though we've been seeing what we've been seeing on the news, and even though that stuff's scary and it makes us nervous, and even though there have been some temporary losses in our portfolios, surely, especially the more aggressive you are, the more losses you probably see in your portfolio. You can just see here, long-term wise, when you're looking at the long-term trend, we're not seeing bonds or cash or even commodities as the number 1, 2, or 3 placer. And if we did, that would be something to be alarmed. But there's really no reason to be alarmed here, in my opinion. This is a different way of looking at it through Dorsey, Wright & Associates. This is a point and figure comparison, so it takes time out of the equation. All we're looking at is a comparison in price. So if all things held constant, a year went by and not a single investment changed in price, then this would stay the same. It doesn't matter how long time goes on. So we're only looking at price here, which is a very unique way of looking at ranking in asset classes. And again, we see international at pole position, domestic stocks at number 2, commodities are number 3 in this case, with cash at number 4. Foreign currencies are at number 5, bonds, again, sitting in the basement where they've been for a long, long time. Okay, let's go look at some digital assets, so cryptocurrencies. Coin, I'm drawing a line in the sand here. It's not as clear because we have this choppiness back here in 2024, but I see a lot of polarity here at this line in the sand at 66. This is Bitcoin, but it's holding that line in the sand. But as you can see, 200-day moving average is down. Bitcoin is below a descending 200-day moving average. So it's one of those things that it's kind of at an inflection point here. Either A, it's going to hold this line in the sand and then eventually resume an uptrend, hopefully, a long-term uptrend, or it's going to break down and continue down and end up in a long-term downtrend. So you could argue that it's already in a long-term downtrend just because you have a high here, a low, a lower high, and a lower low. But I'm looking at this messiness, this choppiness back here in 2024. So you could even say it's neutral or trendless right now. Is a mess. It's not even as clear as Bitcoin is, but again, you've got Ethereum trading at the same place it was way back in 2021, but just a lot of sideways movement over time. So, you get big ups, big downs, obviously volatile. That's cryptocurrencies for you. So not a whole lot to say here. I didn't do a relative comparison chart between Bitcoin and Ethereum because I didn't think it was necessary. I wouldn't be owning either of these cryptocurrencies at this juncture. I'd want to see a little bit more uptrend, a little bit more strength, or as my friend Brian Shannon always says, I'd want to see it prove itself before I'd want to put my good hard-earned money after it, but that's Ethereum for now. If we look at the big picture, just some random charts here I wanted to share with you. This one I thought was really, really interesting. It's not a stock market chart. It's not something I would normally share, but again, it was from JP Morgan's Guide to the Markets, and I just thought it was interesting. It goes all the way back to 1900, and it just shows the average tariff rate on U.S. goods, and you can see that this past year, the tariff rate peaked out at 30% back in April 8th, which is the highest ever going back to 2000. But it was just interesting to me because as I was looking at this to see that tariffs were as high as they were back in the early 1900s. I said 2000s, I meant 1900s. So it was just interesting. Same thing in the late 30s, early 40s, to see tariff rates so high. And then maybe even more interesting is to see in the 80s and 90s and 2000s to see them so historically low at a time when other countries overseas are underpaying their workers and beating us from a manufacturing standpoint. And I don't know, this just says a lot. Here's another one that I thought was interesting. This is the biggest 10 companies in the S&P 500 going back to 1985. So 1985, DuPont, Kodak, Royal Dutch Petroleum, AT&T, General Motors, so GM, GE, Exxon, and IBM. A lot of oil in there. You go to 1995 and you've got the start of the dot-coms, right? You've got your AT&Ts, so little baby bells in there. GE, more oil, Coke, Royal Dutch Petroleum, but then you've got IBM, P&G, Merck. This is before the dot-com bubble really started to go crazy. 2005, after the dot-com bubble burst, you've got IBM, AIG, Johnson & Johnson, Bank of America, Walmart, Citigroup, Microsoft, Exxon, GE, Pfizer. And then 2015, a lot of oil. Chevron up there at kind of the smallest sliver, but JP Morgan, P&G again, GE, Wells Fargo, Berkshire Hathaway, Johnson & Johnson, Microsoft, Exxon, Apple. And then today, the top 10 are not only some of the same names, but Apple, NVIDIA, Microsoft, Amazon, Alphabet, so Google, Meta. I mean, those are all tech companies, except you might argue that Amazon's a communication company. But Berkshire Hathaway, JP Morgan, Broadcom, not only are these the top 10 and maybe a different group than we've seen before, but they make up almost 40% of the S&P 500. Pretty insane. Then we have, this is Sentiment Trader. Sentiment Trader does a risk-off, risk-on indicator that combines a bunch of different indicators into one. As of yesterday, so April 8th, this was still technically in the negative. I think that we'll have to see what happens here, but this is a notch again in the belt for the bears. Something I wanted to share, speaking of risk, one of the things that we do at our office is we often will purchase, at least I'd say once a year usually, we'll purchase for our clients as a core holding in their portfolio, something called an absolute return buffer dual directional note. And the way it works is there's an absolute return feature on the first 10% down. So to the downside, if a year and a day from now this thing matures and it's down 8%, then you would get a positive 8% return. So it's the absolute return of the negative number. If it's down 9%, then you, at the end of the day, end of maturity, you get a positive 9%. If it's down 11%, though, if we're down below the amount of the buffer, then we would lose 1%. If it was down 12%, we would lose 2, down 15%, we lose 5. So the losses here are limited to the amount below the buffer. And then our growth is tied, in this case, the one we just bought is tied to the Russell 2000 index, so small caps, and it's got a cap of 17.15%, which means we can't make more than 17.15, and the issuer is Goldman Sachs. So we did this with Goldman this time, but the best time to buy these things are at times when market volatility is high, when there's a lot of uncertainty. So while we just had another one mature with a cap of just over 15%, which it was tied to the NASDAQ, so it was well over that for the prior year, this one is tied to the Russell, and we're buying it at what I think, we'll have to see what happens in the next few weeks, but I think at a time of high volatility, which is a great time to kind of get in, and hopefully a year from now, the Russell 2000 will be higher, in a perfect world, higher than 17.15%. But again, we've got that protection here down to 10% as well. This is a chart that shows the total year performance of the S&P 500 in the bars. So, and then you've got these dots, which is the intra-year decline. So just to give you one example here, this year we've got a negative 7%, so a 7% drop currently. The lowest drop this year has been 9%, and we're down 7% so far. Last year, the market was up 16%, but it was down as much as 19%. And you can kind of keep going back here. This is 2008. The market was down 38%, but it was down as much as 49%. And then you can see here, 2009, the market was up 23%, but it was down as much as 28%. So it just puts things into perspective, I think, to see that things can get really, really bad or get really scary during the year, but it's time in the market. It's paying attention to things over time and not thinking you're going to win all the time. Nobody wins all the time. This is a put-call ratio. I don't want to get too nerdy here, but when put-call ratios get to certain levels, it indicates market bottoms. You can see here, this was the tariff crash. So if you go back to April of last year, the tariff crash, we can see that the put-call ratio got really high. And here we're looking at the put-call ratio getting to that same point, are almost as high as it was back then, which again is just evidence that perhaps we've seen or we are seeing a market low and that things could get better from here. This is Charlie Bolello, Creative Planning. He puts out lots of great charts, great stats. This goes back to last year, just putting things into perspective. The market went down 12.1% during the tariff crash in 4 days. So these are the biggest 4-day declines, and going back in time, and this is 12.1% last year. It was down 4 days, and then 1 year later, it ended up, the market was up 38%. So you can look at these other times, like 1987, Black Monday, market was down 28.5% in 4 days. A year later, it was up 55%, 3 years later, and up 119%. 5 years later. So you can pause this chart if you'd like to look at this and play around with this, but I just found this really interesting and wanted to pass it along. I thought this was really interesting as well. This is from the Stock Traders Almanac. This is the performance of the S&P 500, so stock market performance before and after the beginning of war, geopolitical, and energy crises. So, and you can just see the averages over time here. So if we look at just all of them, this is the black line here, you can see 1 month before the crisis begins, whatever it might be, and then 6 months afterward. And so you can see what usually happens if we just look at the average of all these types of crises, geopolitical, war, energy crises, it goes down for about 2 to 3 weeks, then it rebounds, bases sideways, and tends to pick up toward the end of that 6-month period. I just thought this was interesting, and you can see how things have gone so far this year with the Iran war. This is total returns of the S&P 500 following the start of any U.S. military conflict. So this is just looking at U.S. military conflicts going way back in time to 1950. And you can see the start date, for instance, of the Korean War. 6 months later, the market was up 9%. Up 21% a year later, 54% 3 years later. If we go down to look at some maybe ones that didn't look so good, let's look at military aid in Yom Kippur. So you can see 1973, the market was down 14%. 6 months later, down 41% a full year later. And it took 3 years before we were back to even. So that was obviously not a good example, right? That was a time when things didn't work out so well. 1999, I mean, it says U.S. enters the Kosovo War, but let's be honest, 1999, that was right before the dot-com bubble, so you can't say that this negative performance out 3, 5, and 10 years had anything to do with the Gulf War. This was a whole lot more to do with the dot-com bubble, right? But anyway, again, you can pause your screen here and you can kind of look at all these and see what things turned out like a year later, 6 months later, 5 years later, whatever you want to see. But the averages here are at the bottom. So on average, 6 months after the start of any U.S. military conflict since 1950, the market's up 7%, up 11% a year later, and I think those are the ones that we're probably most concerned about right now. CNN Fear Greed Index is something we watch every single time I do one of these screencasts, and what I want to point out is not only is the fear gauge at 31, which is relatively low, but just a week ago it was at 13. So extreme fear, 13. What typically happens is during market bottoms is you see extreme fear. Usually at market tops, you see extreme greed. So it's the opposite of what you might think. So it's counterintuitive again. But just a week ago, the CNN Fear Greed Index was all the way down here at 13. Today it's at 31. And ironically enough, a year ago during the tariff crash, it was 2. So get that, right? This is S&P 500 corrections, so market corrections of more than 5%. So pullbacks technically, and corrections, since the March 2009 Great Recession low. And you can look at all these times that we've had a drop of 5% or more, and there's a lot of them, and you can look at all the reasons on the right here for why the markets declined and what the average decline was, and then how many days it took. So the median number of days, 26. You can see here some of them are longer than others, 282 days here from January 4th to October 13th of 2022. That wasn't too long ago. And the average decline again, 7.6%. This is my pre-flight checklist. I won't go through all the details here, but this is something that I pull up every day just to kind of look at, is it safe to trade? Is it safe to invest money? Being that I'm colorblind, I use primarily red and blue, not red and green. And if I'm forced to use green, if I can't program it to use green, which in the case of the elder color system, I have to use green. I have to type it out there so I know whether it's green or not. So you can see here there's a lot of blue and a lot of green. That's what we want to see. There's more blue and green than there is red. And that's a good thing. So notch in the belt for the bulls. And then here's my inverse traffic light, which is on an absolute basis. I mean, drawing lines in the sand here. The market hit the yellow or caution zone here during the Iran war. And then all of a sudden it spiked back up. And this gap up that we saw here on Wednesday, and it's back in the green again. So as much as I'm sure the news is doing everything it can to keep us watching the news, which means it's going to do everything it can to scare us and keep us paying attention, at the end of the day, when we're looking at the numbers, the metrics, the weight of the evidence, this is another notch in the belt for the bull. My good friend JC Peretz, I just happened to see this and I thought I'd pass it along because I thought it was pretty funny. Like me, and probably the reason I'm friends with JC is because we're both very sarcastic. So JC says, marine shippers are probably closing at new all-time highs because no one's moving everything around and recession, right? So we're not in a recession. Clearly, when you see transportation index, marine transports breaking out to new all-time highs, that can't be a bad thing for the market, whether it be here in the U.S. or around the world. Another piece of good news here, this is going back to 2022. You can see the year-end number of 401k millionaires. So this is Fidelity Investments did a study. I want to find out how many millionaires, or in other words, people with 401ks that have $1 million or more. And as of the end of the year 2025, 665,000 people have 401ks in their accounts worth more than $1 million. So that's pretty exciting. Just a quick image here that it's really important to make money. We all want to make money. Investing is all about keeping up with inflation, outpacing inflation, doing the things we want to do in retirement. And I always say money is a unit of choice. The more units we have, the more choices we have. But we don't want to lose money. It's more important to avoid losses than it is to capture gains, at least considering the fact that the market's up 75% of the time. It's that 25% of the time when it's not that we really have to be careful of it. And here's the reason why. When the market's down 10%, no big deal. It only takes an 11% gain to get back to even. But if it's down 30%, it takes a 43% gain to get back to even. And if you're not understanding the math here, this is where it gets really simple. If the market's down 50%, or if your portfolio's down 50%, you have $1 million, it goes down 50%, it's worth $500,000. If you make 50%, you only have $750,000. So if you lose 50%, you need 100% gain to get back to even, which again, I just want to emphasize it's so important to implement risk management and not just leave your portfolio to chance. So I'll end. Just here's all contact information. If you found any of this interesting, if you have any questions at all, you can always fire a question to us at info@libertaswealth.com. No questions are off base. We love talking about this stuff. I always say I haven't worked in 25 years, so this is definitely not work to me. And if you would like a second opinion on your retirement plan or investment portfolio, please by all means reach out to us. We would love to help. And you can also go to our website at libertaswealth.com and click on the little button that says see if we're a good fit. Answer those questions, and we can set up an intro call just to get to know one another. So thank you so much for paying attention, for watching, and if there's anything we can do for you, you know where to find us. So until next time, make it a wonderful week, and we'll see you soon.